Hey, future real estate moguls, are you looking to maximize your real estate investments, but unsure whether to rely on the market's natural growth or to take matters into your own hands with forced appreciation? Well, in today's video, we're diving deep into the world of real estate investing to explore the key differences between forced appreciation and market appreciation. Whether you're a seasoned investor or just starting out, understanding these concepts can make all the difference in achieving your financial goals. So stay tuned to discover the strategies, the risk, and rewards associated with each approach and learn how to navigate the ever-changing landscape of real estate investment like a pro. But first, hit that like, subscribe, and notification bell so that this content will be shared with others and you will get notified each time I post content. I'm Dr. Brown, and I have 13 years experience in real estate investing. And last year, my company did $953,900 in real estate. Today, we are unlocking the key differences between forced appreciation and market appreciation, the benefits and risk of each strategy, and how they will affect your financial investment goals. So let's get started. So I am going to share my screen with you, and we are going to get started from the beginning. Forced appreciation versus market appreciation. So on today's agenda, we're going to talk about topic 1, what is forced appreciation? Topic 2, what is market appreciation? Topic 3, the advantages and disadvantages of forced appreciation. And the last topic is the advantages and disadvantages of market appreciation. So welcome again, and today we will discuss forced appreciation versus market appreciation. As aspiring or seasoned real estate investors, understanding the dynamics of property appreciation is crucial for making informed investment decisions. We will talk about two primary methods through which real estate assets can appreciate: forced appreciation and market appreciation. So you might ask, what is forced appreciation? Well, forced appreciation refers to the intentional actions taken by an investor to increase the value of a property. And these actions can include renovations, upgrades, increasing rents, reducing expenses, improving management efficiency, or changing the property's use or zoning. So if you have a single residence one unit and you want to change it into a duplex, then that's where you would change the property's use or zoning. Investors actively seek ways to add value to the property beyond what the market would naturally provide. This strategy allows investors to generate higher returns on their investment by increasing the property's value through their efforts. So what are some advantages of forced appreciation? So the first one is increased control. Investors have direct control over the value of the property through their actions. By implementing strategic renovations, upgrades, or operational improvements, they can actively influence the property's appreciation. Higher returns. Forced appreciation allows investors to potentially achieve higher returns on their investments compared to relying solely on market appreciation. By adding value to the property, investors can increase its resale value or generate higher rental income. And that's generally what we're talking about when we talk about after repair value. So if you're doing renovations and upgrades, then you're going to have an after repair value on the house, which is going to add value to the property and the appraisal. And also it will allow you to increase your rents on the property or sell it at a higher price. The next set of advantages for forced appreciation is risk mitigation. In some cases, forced appreciation strategies can help mitigate certain risks associated with real estate investments. For example, by renovating and modernizing a property, investors can attract higher quality tenants, reduce vacancy rates, and enhance the property's overall stability because people like to live in a nice place. So if you are renovating the property and modernizing it, then you are going to attract a higher quality tenant. Competitive advantage. Implementing forced appreciation strategies effectively can give investors a competitive advantage in the market. Properties that have been improved or optimized through renovation or operational enhancements may stand out from similar properties, attracting more tenants or buyers. So if your house is on the market for sale and the house next door is on the market for sale and your house has been modernized and updated, then guess whose property is probably going to be sold first? It's probably going to be yours, because a lot of times, unless they are other investors, a lot of times people who are coming to purchase properties are home buyers, and they want the property to already be updated unless they are trying to live in the property and update it at the same time, like we talked about in the last video. So with you updating and modernizing your property that you're selling or renting, that will give you a competitive advantage. And here are some of the disadvantages of forced appreciation. Initial investment. Implementing forced appreciation strategies often requires a significant upfront investment. Renovation, upgrades, or operational improvements can be costly, and investors need to have sufficient capital or access to financing to fund these projects. So this is where you would get a construction loan, or you might have a group of partners who are helping you with the financing of this property and the renovation. Execution risk. There's inherent risk associated with executing forced appreciation strategies. Investors need to accurately assess the potential costs, timelines, and outcomes of their improvement projects. Poor planning or execution could lead to cost overruns, delays, or suboptimal results. So you don't want to go over budget when you are putting in these renovations. Also, you don't want to put in high-end materials in a neighborhood that does not call for that. So you don't want to over modernize or over renovate a property, because you're not going to get the return back because of the value of the community or the neighborhood. So you really do want to be careful with that. Make sure you're doing your research. Make sure you're looking at the comps in the neighborhood to make sure that you are not over renovating or upgrading a property. So 3 more disadvantages for forced appreciation would be market conditions, liquidity constraints, and regulatory challenges. So with market conditions, forced appreciation may be less effective in markets with limited demand or unfavorable economic conditions. Even with significant improvements, investors may struggle to achieve the desired increase in property value if market conditions are not conducive to appreciation. So that's sort of like what I was just saying. If the market conditions are not calling for the value that you are trying to put in a property, then you do not want to do that, because you're not going to get a return on investment. So you want to make sure that you're doing your research, and not only researching the market, but also researching the neighborhood. Liquidity constraints. Implementing forced appreciation strategies can tie up capital in the property for an extended period. Investors may face liquidity constraints if they need to access funds quickly, or if market conditions change unexpectedly. So if you are putting all of this money into a property and you need that capital somewhere else, then you're not going to be able to get it back out of the property that quickly, because it does take time to renovate. And also, if the market conditions change, like it did recently, a couple of years ago, where all of the supplies, like the lumber and the drywall and all of that, the prices skyrocketed, then you would be stuck if something like that happens. So you just really make sure you need to make sure your budget is in a place where you can have this capital tied up without it hurting you in case the market conditions change or something else changes in your financial goals. And regulatory challenges. Depending on the location and the nature of the improvements, investors may encounter regulatory hurdles or zoning restrictions that could impede their ability to execute forced appreciation strategies. So you want to make sure that whatever kind of renovations and improvements you are trying to make, that those are things that you can do on that property in that community by looking at their covenants and restrictions, that will allow you or let you know what it is that you can and cannot do in that neighborhood. For example, I was looking at something the other day, and it talked about how this one neighborhood did not allow multifamily development. So if you were in that neighborhood and you were trying to build or develop a multifamily property, then you would have to stop work, and all of that work would have to come down because that's not something that is allowed in that neighborhood. So that's why I say make sure you're doing your research and making sure that the market conditions are right, making sure that you're researching the covenants and restrictions in the neighborhood you're trying to build in or upgrade in, and just make sure that you are covered with the things that you are trying to do and you're sure of it. So the way to get started is to quit talking and begin doing. That's one of my favorite quotes from Walt Disney. So if you just get started, then you're on your way. So what is market appreciation? Market appreciation, on the other hand, refers to the increase in property value due to external factors such as overall economic growth, increase in demand for properties in the area, scarcity of land or properties, demographic shifts, or improvements in infrastructure. Unlike forced appreciation, market appreciation is driven by factors beyond the investor's control. It is the natural increase in property values over time due to market conditions. Market appreciation can occur even without any specific actions taken by the investor. It reflects the general trend of property values in a particular market. So, market appreciation is passive to the investor. It just happens naturally. So what are some of the market appreciation advantages? Passive appreciation, what I just said. Market appreciation occurs naturally over time due to external factors such as economic growth, demographic shifts, and overall market demand. Unlike forced appreciation, investors do not need to actively intervene or invest additional capital to benefit from market-driven appreciation. Broad impact. Market appreciation affects the value of all properties within a particular market or location, regardless of individual property characteristics or investor actions. Investors can passively benefit from overall market trends without the need for specific improvement projects or strategies. So with market appreciation, the entire neighborhood is going to appreciate or depreciate. Sometimes the market condition can go down as well as up. So market appreciation happens naturally to the entire community or that entire neighborhood that you're looking at. Some more advantages for market appreciation: portfolio diversification. Investing in markets with strong long-term appreciation potential can provide diversification benefits for investors. Market appreciation tends to be influenced by microeconomic factors and market fundamentals, reducing the risk of individual property underperformance. Liquidity. Market appreciation increases the overall value of real estate assets, enhancing liquidity for investors. Higher property values make it easier to sell or refinance properties at favorable terms, allowing investors to access capital or adjust their investment portfolio as needed. So with market appreciation, when it goes up, then you have access to, or you can leverage the equity or liquidity in that property. Some disadvantages for market appreciation: external factors. Market appreciation is dependent on external factors such as economic conditions, population growth, and market dynamics. Investors have limited control over these factors and may be exposed to risks such as economic downturns or changes in market conditions that could negatively impact property values. So if you're looking at a neighborhood or a community where the jobs have been decreased in that area, then this is one of those external factors that's going to make the market appreciation go down. So that's why I keep saying you really have to make sure you do your market research and look to see what are the job factors in that area, the population growth, what are some of the developing planning or planning developments that are happening in that area and in the future. Uneven growth. Market appreciation rates can vary significantly across different regions, cities, or neighborhoods. Investors may experience uneven growth within their investment portfolio, with some properties appreciating more rapidly than others based on local market factors. So it really depends on the neighborhood and the location as far as what happens with the market appreciation. It can go up and it can go down. And the last disadvantages for market appreciation is timing risk, competition, and market cycles. So with timing risk, market appreciation occurs gradually over time and may not always align with investors' short-term investment objectives or timelines. Investors may need to exercise patience and maintain a long-term perspective to fully realize the benefits of market-driven appreciation. So this looks like what you would have the mindset of as having a buy and hold, where you would hold on to the property for a little while longer in order to get the market appreciation in the property. Competition. Strong market appreciation can attract increased competition from other investors, leading to higher property prices and reduced potential returns. Investors may need to carefully assess market dynamics and competitive pressures when making investment decisions in rapidly appreciating markets. So this is a market right here where you would have those bidding wars, where the area has such a strong market appreciation that everybody wants to be a part of that neighborhood or community. So this is where those bidding wars come in on properties. You can see a house that is bid 25,000 over the asking price because of the strong market appreciation in that area. Market cycles. Real estate markets are cyclical, with periods of expansion followed by downturns or corrections. Market appreciation can be influenced by cyclical factors such as supply and demand imbalances, interest rate fluctuations, or speculative activity, introducing timing risks for investors. So it just depends on the timing, the location, and the market cycle, whether that property is going to have market appreciation in the positive or market appreciation in the negative. So in summary, forced appreciation involves proactive efforts by investors to increase property value through strategic actions, while market appreciation reflects the natural appreciation of properties over time driven by external market factors. Each approach has its own advantages, like we just saw, and risks and considerations for real estate investors. So bottom line is, make sure you do your market research in any area that you are investing in. So thank you for joining me today. I'm Dr. Shelley Brown, and I have a course on udemy.com, Essentials of SFR Investing Strategies Made Easy. I will pin that in the first comment so that you can click on it and get started. So I'm going to stop sharing my screen. And I hope you got a lot of value out of today's video. If you have not already, please like, subscribe, and hit that notification bell so that other people can see this content and you will be notified whenever I post another video. So that's all I have for today. I hope you took lots of notes, and I will see you on the next video. Goodbye.